Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London coffee markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production, or recognition of any of the patterns, levels, analysis, or any related items on these, my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that.
New York coffee. The market here has been subject to two separate head and shoulders patterns. The first is a small December 25 to January 26 head and shoulders top for dark blue extension, currently 308.45, which was within the 309.90 to 312.5 congestion area overhead that capped prices last week. The second is a more recent February to March reverse head and shoulders pattern for bright red neckline, currently at 297.40, that is just above the market and running vaguely lower and parallel to the dark blue neckline. I have to admit I am disappointed in this reverse head and shoulders pattern, as after just last week's evidence, I don't think the bright red neckline has much force about it right now, but we shall see. Nevertheless, I felt obliged last week to lay out some potential topside targets, even as I said last week, and I quote, "I am not sure they may be achieved." End of quote. Thus, a primary target X would be up in the 319.35 area, and a secondary hard to reach target X1 would be up in the 327.65 area. So what is in the way of the market apart from the lack of bullish incentive in achieving these targets? Well, there are three immediate resistances. The first is the declining green short medium moving average, currently at 303.55, which has been a good resistance back in January, but I'm not sure how good it is right now. The next is the previously mentioned congestion area between 309.90 to 312.5, containing the 50% Fibonacci line of the May 24 to February 25 move at 310.80. I doubt this will be much of a resistance right now. The final one is the lesser Fibonacci line at 319.95 and December last year's low at 324.40. I'll just reprise what I said last week, which has been somewhat prescient when I said, and I quote, "My concern is that this reverse head and shoulders pattern, instead of becoming a head and shoulders bottom, becomes a rarer head and shoulders continuation pattern." End of quote. There is something else I'd like to look at here, and for this I'm indebted to Ray Bradbury for asking me about New York coffee 49 weeks ago. And I went at the time to my longer term charts, the monthly charts, where we can see some possible insights. You see, on my monthly longer term charts, I noticed back then a pattern that had not been immediately obvious to me at the start of 2025. It was a multi-year, 2012 to 2024, very large reverse head and shoulders bottom for bright red neckline on my chart, my monthly chart, currently at 278.10. The break higher over this neckline reached its primary target on the upside and just about reached its harder to achieve secondary target. Then the market turned lower, significantly lower in February 2025, but the fall held in July and again in August last year, with the market forming a small base right on top of the bright red neckline. Then in August 2025, the market raced all the way back up, with an extension higher in early September 25, though not reaching quite as high as we saw back in February last year, before dropping once again, and finally last month reaching the bright red neckline once again. In all these actions, the market has formed what looks like the mother of all long-term bearish double top patterns between late 2024 to date. So where now? Well, consecutive closes below this bright red neckline, assuming no false breaks, of course, and that's a big assumption, but consecutive closes below this bright red neckline, we would have such a double top pattern with all the implications such a move lover might have. Please just remember these patterns here on this monthly chart are longer term, in some cases very long term patterns, and I cover them more fully in my longer term coffee technical analysis video published in January. In the meantime, please just keep that bright red, slightly breached but not yet broken neckline, currently at 278.10. Please keep it in mind. London coffee. 42 weeks ago, I said of the bearish pressure on this market, and I quote, They now have that overhang of the market from roughly 5,300 up to this year's high at 58.49, sitting above. End of quote. So this overhang of bearish pressure and ammunition is important as it started back then to press down, magnifying the breaks lower. The main overhead resistance since then, the dark blue February 25 to date downtrend, currently at 40.27, had enough of an impact on me that I drew a parallel bright red bear channel based around it, currently 32.49 to 41.21. Back then, back in September last year, we had some previously significant resistances that turned into supports, notably the trio of interesting 50% Fibonacci lines. The first, the November 21 to February 25 move at 38.08. The second, the May 21 to February 25 move at 36.49, which held the market in late December last year. And crucially, the third, the March 20 to February 25 move at 34.81. All three have now given way, as today we are well below the 50% Fibonacci line at 34.81. So with all these moves lower, what now? Well, I said 5 weeks ago, and I quote, "We might take a leaf from the New York Coffee's book and look at the last 3 weeks' actions as a possible descending scallop pattern." End of quote. This seemed the likely case back then, and I went so far 4 weeks ago as laying out a primary target X down in the 34.15 zone, with a secondary much harder to reach target X1 down in the 30.04 zone. I added at the time, and I quote, "We'll now see over the coming weeks of this if this vicarious analysis from New York Coffee works here." End of quote. Thus, on the basis of this, 5 weeks ago, I laid out a primary target X down in the 34.15 zone, for a secondary much harder to reach target X1 down in the 30.04 zone. 2 weeks ago, we reached target X down at 34.15. And immediately turned higher and I began thinking, okay, maybe the primary target will be all we could see. But this week prices have powered through target X. And I am now optimistic of reaching the secondary harder to reach target X1 despite the distance lower and obstacles in between. Now during that time we have initially created a small early February to late March bright pink bear channel, which is currently 34.20 to 37.82. That seemed to fit the bill. However, today I've morphed that pattern into an earlier February, still bright pink, February descending wedge pattern, to date descending wedge pattern, currently 33.52 to 37.82. And I am now thinking if I might have to retire both of these today, as we've just been pressuring the downside, but we've just pulled back up again. And if that was, well, then I would just have to rely on the bright red bear channel instead. Additionally, I drew 5 weeks ago something I've been thinking about for a couple of weeks, an October 25 to late January 26, bright green bearish Andrews pitchfork. The market has tested and breached the overhead bright green upper time a few times, and it's currently at 35.43. But today has pulled lower enough that I'll keep this bright green bearish Andrews pitchfork as it is. However, as I said 5 weeks ago and ever since, and I quote, "I have no qualms about morphing this bearish Andrews pitchfork to a shallower bearish shift pitchfork for the same move if the action requires it."
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.